This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
New all-time highs are bringing a fear of missing out front and center. Well, this week, instead of tempering your expectations and telling you what could go wrong, I'm going to talk about why this is actually justified and it can keep going, followed by an update on a very popular stock who had a tough week in the market. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein, one of the team's portfolio managers, and it's a short week for me so far. I'm recording this on Wednesday, but it's been a busy week. We've had a lot of important data coming out, and maybe the leading story is the reliability of the data. How much can we look to it? Like as I said, I'm actually recording this a day before the really important producer price index numbers are released for the month of July, and they may be mostly benign, much like the CPI numbers were earlier this week, or they may show a leading indication of tariffs kind of building prices up in the pipeline. You know, the consumer inflation data came out on Tuesday, and while the core numbers did show a pickup over June, and they were a tad above the consensus, the reading of 3.1% inflation, it wasn't getting anyone too worked up, and the markets actually just keep rallying pretty well off of it because it is now looking full steam ahead to the September Fed meeting, where the market is now pricing in a 90% chance of an interest rate cut, with some economists publishing reports that they expect up to 3 cuts remaining this year. And our Secretary of Treasury was calling for them to cut by 50 basis points at that September meeting alone. And this is why the PPI number is going to be important, as it has the potential to scare the market a bit away from these bullish assumptions about monetary policy. But unless it's really cooking, we are basically dealing with a strong economy here, one that has pretty much low inflation and very low unemployment, and we're going to get some fuel added to that fire in the near future. In an interview this week, Brian Moynihan is the CEO over at Bank of America. He's running one of the biggest banks in the world, and he said that we're basically 1% away in the United States from full employment, and emphasized that wage growth in the U.S. has exceeded the inflation rate for almost 3 years now. So not just for one period of time, but for an extended period of time, the average worker in the United States has been earning more and more than the rate of inflation. That positions the consumer pretty well right now. And now on top of that baseline, we're going to get lower interest rates. If so, that will add a lot of cash to the system. Lending is going to be that much easier. We may see housing activity start to pick up as it's been lagging recently in face of what's been stubbornly steep mortgage rates. And one could expect to see equities, to see stocks carrying even higher multiples relative to the results as the discount rates of future returns trends lower. As interest rates go lower, everything else being equal, stocks trade at higher valuations. And in reaction to the CPI numbers this week, the folks over at Strategis published a piece in which they said, quote, before the recent tariff shock, end quote. I'm not sure what tariff shock, but I guess we had a tariff shock in April. Maybe that's what they mean by that. All right, but let's try this again. Quote, before the recent tariff shock, inflation appeared anchored. Tariff implementation had been haphazard and partially delayed in 2025, ... We expect rate cuts to resume at the September FOMC meeting, end quote. So unpacking that, the tariff shock, again, I don't know if they mean Liberation Day and what happened in April. Inflation did not appear anchored at that point because inflation was quite a bit lower over the last 12 months. Tariff implementation certainly has been haphazard, and that's what the markets have been doing well versus that we keep getting extensions and delays and deals. And again, that's why I'm looking at PPI, but not expecting much. I'm just kind of hedging this because I'm publishing a podcast the day before, and that's what has the potential to really throw a wrench in the works this week, but I'm not expecting it to. The majority of tariffs in the headlines have been delayed. China just got another 90-day extension And, they seem to, I guess, be working on a deal there, which is why they got the extension. Overall, what's been implemented has been largely absorbed so far by a combination of the exporters, the companies originating the products coming into the United States. Although someone had a nice point on CNBC on Wednesday morning, I guess Steve Leisman maybe, but saying that, well, how is there's not a lot of margin built into these exporters, those who are manufacturing in these markets for export to the United States. There's not a lot of margin there. So I'm not sure, he was saying wasn't sure how much margin there was to cut to absorb the tariff rates. But it's also being absorbed clearly by the importers, which is, again, maybe I'll stop saying this over and over again, why it may appear in the PPI report. The actual U.S. companies that are importing the goods have been clearly and openly absorbing some of the price so far. In another report on Tuesday, strategists pointed to weak tax revenues as evidence that corporations were eating the tariffs themselves, allowing the tariffs to eat into their margins while at the same time taking them as deductions, as tariff revenue is up $70 billion right now year over year. But corporate tax revenue is down $44 billion. So that might be where the difference is. So we may see it appearing more soon on U.S. store shelves. But for now, the bigger impact of new legislation on the economy may be reducing available labor due to reduced immigration. That's showing up in the wage reports. That's what may have a bigger lasting effect on the economy. But that also may largely be offset by these coming rate cuts. If corporations continue to absorb some or most of these tariffs themselves, it will indeed, of course, be an impact to their margins and their profits, and should be considered when you're looking at sectors of the market that may, the sectors that aren't the hottest, those that may appear cheap in today's markets. The hot stocks are the ones that actually have the most resilient margins. Those are the ones that feel or little or no effect and have plenty of margin to work with. Those are the big tech companies are not going to feel a tremendous amount of this unless trade wars get a lot worse with reciprocal tariffs. But while this is all not a very revolutionary thought I'm sharing with you here, and those types of companies think things like, if you're thinking about companies like software companies, these are the ones that have been doing so well in the markets. But this is also could argue the case that they can very much continue their leadership here if rate cuts smooth the way for them to basically sustain elevated valuations for the foreseeable future. There's a further boost to this now as the new federal tax legislation made permanent the corporate tax cuts and also added a big benefit to some companies because these companies can now deduct 100% of capital investments in the first year those investments are made, which allows them to write off large capital R&D costs, factory investments, as well as added benefits for their interest rate costs on their debt. Now, according to that strategist report, 117 companies last week alone in their quarterly conference calls cited this tax bill with these specific benefits helping to offset the expense of tariffs for now. One sector that we've mentioned a few times this year, because sometimes we have to look beyond companies that are working on AI, I guess, is the financial sector, which is going to see a lot of benefits along with some negatives from this, I'll say, evolving economy and the expected change that we're going to see in monetary policy. Now, according to Goldman Sachs, large banks delivered results ahead of their estimates in the first half of this year. And now heading into the second half, Goldman's focus remains on the net interest income and the improvement in the overall capital markets as the economy here accelerates and corporate banking becomes more robust and the so-called IPO window seems to be swinging open. Now, net interest margins will be interesting to watch. Well, maybe not interesting to watch. I mean, I'd rather be watching baseball. It's pretty boring overall. But I'll say net interest margins will be pretty important to watch here. When interest rates rise, you may have noticed over the last few years, as interest rates were previously rising, that banks didn't really rush to immediately pass along those higher interest rates to consumers. You didn't see them immediately raise your money market interest rates. because of that, a gradual, steady rise in interest rates can directly contribute to profits as the spreads widen for these banks. Well, for a while at least, the same can be true, oddly enough, in the other direction. Because watch what your money market rates do after the Fed, if they do indeed make a rate cut in September here. You'll see the banks actually immediately. They'll cut those interest rates on money markets, the rates that they're paying to consumers, they'll cut them right away. But they won't necessarily cut the rates that they're taking in terms of lending. And in some cases, they have to. There are a lot of loans in this world, a lot of money tied up with loans in this world that are pegged to a base rate with a set spread over it. The loan is a base rate, which the Fed can have a large correlation with, at least. They don't control it, but they have a large correlation with it. And the bank has set a loan. It's written on the loan with the spread. And in which case, this won't matter too much, except that as interest rates come down, the spread remains the same, but total loan demand and volume should rise and increase, which leads to better revenues for the banks. However, if they can compound that effect with accelerating interest in domestic borrowing by capturing more margin there, then the bank's earnings and the multiples to those earnings can do very well right here. And that's kind of what we are anticipating and what Goldman is saying they're anticipating for the second half of 2025. What's more, as interest rates are lowered, the value of the bank's assets, what they own, what they carry on their balance sheets, rise. Much the same way that if you own a bond in your portfolio and interest rates go down, that bond's value goes up. So in the environment in the second half of this year, what we'll be looking for is the book values of banks to tick higher and then them to command higher valuations versus those higher book values. And if we do remain in what Moynihan was describing as a bit of a Goldilocks economy, this is all going to be a good situation. It's going to bode well for the banking and the financial sector overall. All right, I'm going to run into a quick break here, but when I return, I'm going to focus on a specific stock, totally different sector, but something that's certainly been notable recently. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Almost everything that lagged last year, value, international, and more defensive stocks, have held up relatively better here in 2025. Is this just a knee-jerk reaction or a more sustainable trend? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. A company we have in our clients' portfolios. It's a company I own personally. Well, I'll say made a bit of a spectacle when they released their second quarter results and also the results from an updated formulation of their very, very popular weight loss drug. And here I'm talking about Eli Lilly. And while the stock got beat up pretty good that day, down about 13%, I think over 14% at the worst part of the day, I'm first disclosing here that, well, we have a positive bias to it. So you should consider that when you hear my opinion on the stock. And I'll try to share other opinions, but we use this as an opportunity to add to the position. But I'll let you know what some folks on the street said about the news, and well, maybe we'll consider what their bias may or may not be. The quarterly results themselves were generally well received. The company beat on revenues, it beat on earnings. They raised their full-year guidance. Their margin guidance for the year was strong. And those are the areas that, if anything, had tripped up other companies this earnings season. But for Lilly, the focus was the prospect for the oral version of their popular weight loss drug, as it compares as a more favorable and potentially a more widely adopted version of what is now being used on the market as an injection, I think once a month injection. So if you can sell it in the pill version, you can market it to many, many more people, I guess. But the safety results were favorable. Thankfully, there wasn't a problem there. Favorable compared with the injection. But the focus continues to be on the discontinuation rate of the drug. How many people were taking it and then ceased to take it during the trial, which the street blamed on the modest results from the drug, that people basically didn't see the value proposition. They stopped taking it. There were some modest side effects, and people decided to stop taking the drug because they only got an average weight loss of 12% of their body weight, while the company and other analysts, the company specifically themselves, pointed out that the discontinuation rate was much higher in the placebo group, where presumably there weren't side effects, but maybe they were discontinuing there because there was no benefit. But either way, the company said they were happy with the 12% weight and that there could actually be increased benefits with other revised formulations. For what it's worth, the stock has rebounded a little bit. It's up about 7% from the low it made that day. But let's go on and see what the other analysts were saying here. According to FactSet, 80% of the analysts on the stock have it rated as a buy, with an average price target that's been, because of this report, reduced by 1% to a target price of $949 a share, which is about 50% higher than the stock is trading today. Obviously, that could be revised more, but this is now quite a few days after that report. Now, first, starting off, let me try here to share a negative perspective with you, and I'm sure there are more out there, but from what I had at my disposal, I only found one, which was from Leerink Partners. They downgraded the stock to neutral, and they lowered their target price to $715 a share, pointing out that while the oral drug is still expected to deliver revenue growth, they had a larger focus on competition coming from Novo Nordisk. Novo, who seems to have fallen behind on competitive advantage for these drugs, but is instead competing on price because they're making side deals with the PBMs and with other insurance companies. The analyst over at UBS says this sharp stock drop was just a, quote, unwinding of a crowded trade, end quote. And they maintained their buy rating, but they did lower their price target to $895 a share from where it had been at $1,050 a share. JP Morgan maintained their overweight and said that they view this week's stock weakness as a buying opportunity. They went on to say that while the oral results were lower than their own forecasted efficacy, its use case remains intact, with a big ramp up for it in the second half of next year. And the stock now trades at about 24 times these next 12 months' earnings estimates. And that's a lot traditionally for a pharmaceutical company. You might look at biotechs with cutting-edge drugs that are coming to market, trading at multiples that exceed that. But maybe an old-line pharmaceutical company would trade cheaper than that. It's kind of in line with really where the S&P overall is trading. But it is versus its own 5-year average. Lilly has its 5-year average valuation of 30 times earnings. So it's somewhat a 20% discount to that, at least. Over that period of time, it had traded as high as 45 times its forward earnings, and that must have been really at the peak of the aforementioned crowded trade. And it had also traded over the last 5 years as cheap as 16 times earnings, but that was really at the beginning of the period where these weight loss drugs were not even a twinkle in my eye, I guess, before they became all the rage. Of course, drugs, especially trending drugs like this, relatively new to market drugs, although these formulations have actually been around for a long time, just not with these applications. But that being said, there's always some additional risks with pharmaceuticals, especially leveraged to just a few drugs. There are right now additional threats of tariffs specifically targeting pharmaceuticals. Lilly does not carry too much exposure there. But there's also the risk that these drugs might turn out to be very, very bad for people. as currently being used. Now, again, they've been through a gauntlet of testing, but still, we've been blindsided by drugs before. So let's, temper any enthusiasm. It is discounted here versus certainly where it's recently been. We just don't want to go too wild on it. For what it's worth, though, management in the report did emphasize that this current year's sales are ahead of previous guidance. It has nothing to do with this oral drug, but also in subsequent interviews after the report, they did say that additional formulations of this drug are expected to be introduced, which could give even greater efficacy. All right, that's it for me this week. Thanks as always. I'm Chase Hinderstein. Again, as always, thanks for tuning in to the Wise Investor Show podcast.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.